How are things going and what's happening when it comes to the housing markets these days?
Well, the numbers I find, and I'll talk about national numbers,
Yeah.
they're really different on each region
Oh, for
across
sure.
the country,
Yeah.
right? So the national average home price right now is 672,000, which is down 2.7% from previous month. And then it's up just slightly, like by zero point 0.8 year over year.
Okay.
Now, if we're looking at sales activity and we're comparing it, because we always compare it to the month before,
Yeah.
so we don't really have September stats yet. We're more basing this on August. And I find July and August a hard metric
Mm-hmm.
to really talk about because it's not a realistic market to the rest of the year. A lot of
Right.
people taking holidays, and there's not a ton of activity. But if we are going to go on those metrics right now, if we have to compare to July, sales were up 3.8%
Yeah.
month over month and 6.6% year over year. But we have to remember last year in July, that was the lowest amount of sales historically ever.
Right.
And
Right.
so it's a hard metric to gauge, but it's still one to say we're going in the right direction,
Okay.
right?
Yeah.
Things are starting to slowly rebound. Now, if you look at active listings overall across the country, listings are up 10% year over year. I think a lot of that has to do with mortgage renewals and
Mm-hmm.
people having to sell, not wanting to sell. I think that from an affordability perspective, people have been, the loss of jobs, and, we're going to get into what tariffs and the impact of
Yeah.
that has done on
Yeah.
Canada. And I think a lot of people are looking for alternatives to help with financial ease overall in life. And so they're going to more provinces and cities that are more affordable. And we'll talk about, where I feel right now that it's kind of hurting a lot of people right now to be able to live in these cities because of affordability.
Okay.
But overall, nationally, sales to new listing ratio, which is called the SNLR, is about a 52%, which means that it's a balanced market. But I
Okay.
say it's balanced in certain aspects. I don't think every market is balanced. I think some markets are sellers, some markets are more of a buyer's market. When you look at Ontario specifically, Ontario is much higher price point than the average of the national one. So Ontario's average price point is 822,000. So
Okay.
that's definitely up from the national average. And it's up about 6.9% year over year. But when you look at activity in terms of, sales in Ontario and listings, it is a softer market because it's harder to afford Ontario right now
Mm-hmm. Mm-hmm.
because of the price points. Yes, we've had values come down, but it's still overall, when you look at where income is in Ontario versus where the average home price is,
Right.
income has an index to inflation. And when you look at how people are spending, for every dollar they're earning, they're spending $1.71.
Okay.
So they're spending more than they're
More than, yeah.
earning.
Absolutely.
And it's hard, right? But if we look at even BC, which has always been a higher price point, actually GTA is almost, that benchmark's actually becoming a slight higher than BC, believe
Mm-hmm.
it or not. And we're finding that in areas such as Quebec, it's more of a affordable, which I never really talked about Quebec or Montreal before,
Mm-hmm. Mm-hmm.
but this is actually where we're seeing a lot of housing activity because the average price is more affordable. It's around 540,000, and we're seeing that values are going up. The listings are going up, but more sales are. It's more definitely a buyer's market,
Yeah.
even in provinces such as, in the Atlantic in Newfoundland, the benchmark price has gone up 11% because it's so affordable
Right.
there, right? People
Right.
are moving there, and if they're
Yep.
still able to work from home, it's, or they can find and relocate with their employment,
Yeah.
which I tend to think that might be a bit tough in Newfoundland because the unemployment is quite high there. But if
Yeah.
people are working hybrid, then that's more of affordable. You can get more for a house, and
Yeah.
financially it makes sense, right? And then in provinces, such as Saskatchewan and Manitoba, which is not something, provinces I've typically talked about in the past because the market hasn't really moved the needle on price points there from real estate. We're seeing that going up like 1
Correct.
to 11% year over year because it's more affordable, and people are outweighing affordability than the luxury of where the weather is in a day, right?
Right.
Like
Right.
they seem
Exactly.
to put up with longer winters,
Yeah.
harsher conditions on weather for affordability and a better ease of life
Yeah.
because of that. And then Calgary's had strong gains, as we know, over the
Mm-hmm.
last few years, but we're starting to see that turn a bit. And we're starting to see that turn still a little bit in Edmonton, but still Edmonton's more of an affordable market based on people looking at it to live in, but also from an investment perspective as well. So it's really a mix, probably more than I've ever seen before. And I still think we're going to see that continue. I think, the harder markets we're going to see come into play is going to be Ontario, because when you look at it over the last few years, even though we've had this hockey stick of values going up, 50% in those peak times of between 2020 and 2022, well, part of 2022, values have come down about 24% in our market. And that impacts people. It impacts people coming up for renewal on their mortgage, which we're going to be talking about. It impacts people to be able to pull out equity to either, buy another property for investments or consolidate debt, or even sell their home because they need to downsize or sell their home and go into retirement space, which we have a lot of people in that age bracket in Canada. So Ontario is such a big part of the percentage of housing market in Canada because of the geographic space and the population we have. It does affect the overall median values.
And I think too, we know that the province has said that, provincial workers, you're back to work, like you're not working from home anymore.
Yeah.
So that means if that's the case, you're going to be buying a home fairly close to where you work. Gone are the days for a lot of people that, they go to and they bought a place up in cottage country, or they bought a place, Sault Ste. Marie, Sudbury, and they can work remotely where as you were talking about, the prices are lower. We were visiting Montreal this summer, and I was talking to a guy there. He rents, he said, and he has friends in KW. He said, I rent a 3-bedroom place. I spend just over $1,000 a month rent. He said, same space here in KW is $2,400. So even if you're in the rental market, but you're right, that idea of a home in Montreal going for just over $500,000, you'd be paying $800,000-900,000 here, right? So all of those things, we think, there was that time where maybe moving to a different location and continuing to work would work, but it doesn't seem to be the case anymore.
Well, and I think that, listen, Canada, it has always been based on a credit-driven market.
Right.
But it's because we've had like a 10-year span of lower interest rates when you sit and think about it between 2010 and 2020. Well, I'm going to say part of 2022, okay?
Yeah.
So we've had lower interest rates, so people could wrap around that mindset of accumulating debt and continuing to do it for, the potential. And what we were seeing is equity rising in housing investment strategies on real estate. But the amount of turnaround that we've had in such a short period of time, in 3 years, just because of how much rates have gone up. And even though when you sit and look at it, where interest rates are sitting at right now, which are the high 3% to 4 range, or 4.5, like in that range, which realistically isn't a high interest rate environment.
No.
We've had it higher than that. We were close to 7% less than 12 months ago. Look how much that is sensitive to the real estate market and people's affordability. But, it's also impacting, if you just look at inflation as a whole. Yes, there's some things that have come down. Rent is starting to come down. But, go to the grocery store, go out to a restaurant. You and I talked about this.
Yeah.
I went out with my son yesterday for dinner, and we were talking about this, and we're not drinkers. And we didn't have dessert, and we just had modest meals, and it was $200. That's insane.
Right.
So locally, we're still seeing, and I look at it a little bit different locally, because I think it's based on certain neighborhoods as well, where the activity is. Overall, the average sale price in the Kitchener-Waterloo region is $735,000, which is down about 5.8%. Month over month, and down year over year about 6.1%.
Okay.
But when we look at it, and I've got the list here of like when you look at the different types of homes, so detached homes to townhomes, condominiums. We're all seeing slightly decreases in values. That's not something that's surprising right now.
No.
When you look at it, interest rates are still high. It's hard for people to qualify. We haven't seen rates drop that we were expecting. People still have to get stress tested to qualify for mortgages. And the first time homebuyer age to actually buy a home has gone up exponentially. Like It's now 35
I
years
was gonna
old.
say, I thought it was like 35, 36. Oh my gosh.
Yeah, it's definitely gone up, and a lot of that has to do because income is not there to help qualify.
Right.
Even though the average income for a first-time home buyer, when we're looking at them entering into, is about 105,000.
Yeah.
It's still not enough for one single person to be able to afford a house, like especially in this area. And we get a lot in this area where we've got a single person looking to purchase and they're making great money, but to buy for like 650,000, which you're not buying a detached home,
No.
you're buying a townhouse or maybe even a condo in that price point. You've got condo fees, you may have a car payment. You're not able to put minimum down payment down, which is closer around that 6.5–7%.
Right.
So we have to get a strong cosigner for you, whether it's your parents or they're gifting you a lot more money down to qualify. So I think that this is why we're seeing values come down a bit as well, and we're seeing days on market. So that has increased. So when we looked at that, that's actually increased quite a bit. If I looked at it this time last year, it was 22 days on market. Now we're up to 32 days.
Okay.
So it's taking longer to sell homes. Having said that, I've seen, especially in the detached home sector, I've seen homes sell quite quickly in even a week. But again, it depends on neighborhood. It depends on the type of the property, the condition of the property. Is it close to very good schools?
Right.
How are they graded? Because people look at that, when they've got families coming in. Or is the property one where they can do renovations to add in an income suite, foreign mortgage help, or help put that income suite in because their parents or other family members are coming into the property so they can cohabitate together.
Yeah.
So we're seeing more people, and that percentage increase of people buying detached homes and actually doing renovations to the properties to help bring that generational home or that part residential, part income home dynamic in there. So you can say it's a balanced market, but I think right now it tends to lean more in our area of a buyer's market, depending on the area you're looking at. And I find that right across the GTA. Like there's a sector in Burlington, and I've had first-time home buyers lose out on over 9 offers on different properties. I couldn't believe it. I felt like I was in like 2021 again. They were actually even doing letters to people, to the homeowners, saying why they wanted the property. They had their business that they were able to work out of the home as well, so they definitely needed to get a space quite quickly. And they had to take a property that not necessarily was the one that they wanted, but they could do a lot of renovations to make it what they want, and they finally got it on the 10th one and had to pay $80,000 above list. Now, what does list look like? I mean, it's not like these prices were overlisted back like we saw in 2021, but they were still higher than where the market was. So there's these anomaly areas where I find that it's almost like a 2021 era, but they're small and in between. I mean, overall, I think the market is still recovering. I think tariffs impacted because interest rates haven't moved, bank prime hasn't moved to where we've wanted it to be. Unemployment is definitely going up. And the unknown and uncertainty is still what the elephant in the room has been the last 3 years. And people are, taking their hands and kind of sitting on their laps, just saying, okay, I'm just going to wait and see right now.
Right. And if it's a buyer's market, people they think time's on their side, and they can go in and say, well, this isn't exactly what we're looking for. We're going to be looking at something else. And as you said, 32 days on average on the market. So it's not like people, when we talked in 2021 or 22, people were making decisions that might not necessarily be. Their heart was making the decision rather than their brain, right? They're like, I've got to sell, or I've got to buy, and now you can maybe catch your breath a little bit as a buyer. From a selling standpoint, it's obviously it's frustrating, but it sounds like, and as you said, people have to get creative.
I do, and I think there is ways. I think people have to sit rationally and logically and speak to a mortgage professional and their accountant and their financial planner to work on the best strategy to buy a home. And we should have been doing that all along as well anyway, which I've always recommended, through the years. But, I realistically look back, and I look at when my husband and I first bought our home. Back then, yes, it was different, but it was still, we had challenges in the economy. We had challenges globally. There was challenges actually back then with employment as well and inflation. But we you tune out the noise to some extent. We didn't have obviously the social media platforms, and I think that's really where the biggest challenge is. There's so much information out there, whether it's good or bad, it's out there, and people love the narrative of the negative. That's what drives a lot of influencers, a lot of that entertainment, not education out there. And so we get addicted to that, and then it ends up being part of what your mindset is when you're going to make any decisions, and you sit back and not do what's logically or the opportunity that's right in front of you. And when my husband and I bought our house, when we first bought, we didn't look at all that. We looked at our employment, what could we afford? We needed to make sure that we were starting a family. We just had my son. We wanted to be close to a park, close to good schools, and we bought. And we didn't worry about where values were going because this is a house that we were going to stay in for a period of time. Now, we only stayed in it 4 years, but we didn't know that when we bought. And again, we didn't look at it as a cash cow of being able to pull out equity continuously to draw on. And I think that, yes, things are more expensive. And I mean, I'm the first one to admit it. I see it all the time in people's financing. But I think that, we have to still look at, do you have a good job? Are you a growing family? Or even if you're an individual, do you have the means? Do you qualify? Do you want to own a property? Do you see real estate as a long game and not a quick win, right? And when you look at the compounding interest effect, even on investments, the biggest people that are financially successful on their financing and diversifying their portfolios just stick into, different caveats of being able to do investments because of the compound effect of interest, kind of like, park it into an EFT or a mutual fund, and then just don't even look at it and just move on because you've done that. And you sort of have to do that also with real estate, right? You got to have a pulse on it, but you have to understand that that's like, it's there, but it's there for the long haul. It's not going to be this 20% increase in values in this win. And everybody takes that 2020 and 2021 cycle as this continuous momentum of real estate wins, and we're not there, right? Well, this month definitely is an interesting month. We have a lot of data that's coming out of the U.S. and Canada that I think is going to help give us a better perspective on what this, the last quarter of 2025 will look like and going into 2026. I think yesterday's report on Friday on the job market in Canada and the US and how much we fell short on jobs. Like in Canada, we only created 66,000, we lost actually 66,000 jobs in August. And that's the worst since the pandemic years, right? And we looked at unemployment, it actually jumped to 7.1%. And a lot of those jobs, losses were concentrated in part-time jobs. So to me, when I'm speaking to a lot of clients, and my team is, most people nowadays in Canada do not just have one job. They have one and a part-time job. So are these the jobs that we're looking at that are getting lost to help people offset, cost of inflation? And then office-based jobs, where is the other sector that we saw, a deep drop in job losses. And also when you look at the U.S. lost jobs. In fact, theirs was horrible. I mean, they only added 22,000 jobs in August, right? So they fell
350 million people.
They fell short by their market expectation was 75,000. So their unemployment ticked up to 4.3%. But going back to Canada, because that again is my focus. I talk about the U.S. because it impacts our market for sure and our fixed rates. But there was a quote that I'm going to say right now, and this was from TD Securities, and they said. When you look at the trends of what's happened with employment and unemployment in Canada, the trend, he says here, the trend is not your friend here. Job losses are, and probably not quite as weak as headline numbers suggest, but that's only because the headline number was putrid. So, I mean, basically, in the nutshell, when you're looking at September 17th, announcement from the Bank of Canada, and ironically, the Fed rate is the same announcement on the same date, which doesn't happen that often. It's usually spread out a bit. Now we're seeing the Bank of Canada market sentiment, about 86% chance we'll see that 0.25% drop in Bank Prime. So to put it in perspective, Bank Prime's at 4.95%. We should see it come down to 4.7%. So for everybody that's listening, if you have a variable rate mortgage, an adjustable variable rate mortgage, or looking to take that type of product if you're purchasing or coming up for renewal, for every $100,000 that you owe, your payment will come down about $15.
There you go.
Okay?
Yeah.
So that helps
Yeah,
for sure.
For sure it does.
And also in the US, they're expecting to see finally their 0.25% drop. They've been really, really reluctant to make any moves this year.
Yeah.
I know we've been more proactive. Our last time we dropped Bank Prime was in March of this year.
Right.
So we're definitely due. We have another 2 announcements after that. And there is a market consensus today, and I say today because it could change next week or the following week, that we could see another quarter or another half. Like we actually are now talking back to potentially 75 basis points to a half. I'm more on the conservative that in total we'll see a 0.5 point drop in Bank Prime. So we should see Bank Prime on the lower part of, around 4.4, maybe even 4.2 if we are aggressive.
Yeah.
And when we look at variable rate mortgages, we have to remember it's not just based on Bank Prime. Let's say we end up being at 4.2 at the end of December 2025. Typically, the banks will offer you a discount off of Bank Prime if you're taking a variable rate mortgage. And those discounts can range from, prime minus 0.20 to prime minus 1%. Or if you're in an adjustable variable rate mortgage, you're going to see your payment come down and your rate come down quite a bit.
Right.
So, and put it in perspective, because I have a lot of clients right now that are coming up for renewal. I mean, this is a big renewal year. Next year is even more.
Yes.
And they're coming from a variable rate mortgage from 5 years ago. And back then we were seeing a 1% rate drop in a variable rate mortgage. Putting it in perspective in today's rates at Bank Prime at 4.95% with a 1% off, we're at 3.95%, which is pretty good.
Yeah.
If you actually look at 5-year fixed rates, depending on the type of mortgage product you're taking, there's some rate specials out there right now. We have one of the banks offering a 3-year fixed rate. If you're looking to transfer your mortgage at renewal or refinance, we're looking at an interest rate right now of 3.89%,
Wow. Okay.
which is great.
Yeah, absolutely. I was going to say, when it all gets tied together. We see the unemployment rate over at 7%. Basically, that's sort of going to be forcing the hand of the Bank of Canada to reduce that overnight rate. Talk to Tracy, right? Give her a call and say, hey, this is where I'm at. I may be 3 months out. I may be a year and a half out. But what should we be looking at? How do we make the most of where we're at? And we know that life changes. It may be that you're retiring. It may be that you're still carrying a mortgage, or your job is changing, or there's all kinds of those variables that are going to be playing into your world. Do your homework, and it starts with a phone call to Tracy, and she's going to put you on the right track. I suppose it's really that idea. You can't really start too early, right?
You can't,
right? And things will change, right?
100%.
You know that, but at least start paying attention to what's going on. And because, as we've said before, it can't be that sort of set it and forget it idea.
100%, it can't.
You have to be paying attention. When Tracy's in your corner, though, you can ease up a little bit. You can think about other things. It doesn't have to be. You're not losing sleep at night. You're able to sleep because Tracy's doing all the work for you. Well, sort of.
Oh, we're starting it. Yeah. We have to work together, right, to get it done. But absolutely.
And we've talked about that before. The idea that when people come to talk to you, they're going to be doing some homework, and you want them to be coming to you. And there may be some difficult discussions when you first start out. Right, when it comes
absolutely.
to finances but you've also talked about that idea from a mental health standpoint that just let's have the conversation, because you can't, if you bury your head in the sand, that's not going to make anything right. It's not
absolutely
nothing's going to go away.
And I've seen that. Like this year has definitely been a year of the conversation about renewal. Mm-hmm. There's always a year where I tend to have more of a topic that's trendy.
Yeah.
I would say in the real estate and financial sector, but renewals is such a hot topic, and it's such a big topic because when you look at it realistically, 5 years ago, and even in 2026, so like into next year, so basically 5 years before that was 2021. So in 2020 and 2021, we had 4 times worth of mortgage volume and real estate volume than we've ever had, right, historically. Right. Yeah. So there's a lot of mortgages coming up for renewal. And when we're looking at where interest rates have gone, we've had such a pendulum of shift from interest rates going up to cycling down and inflation. It's really affecting people's affordability. And what's happening is there's a certain sector of the Canadian homeowners that have mortgages that are just putting their blinders on, and they're coming very closer to the renewal date. And it's a shock, but it's also not allowing them the opportunity where if they would have come in advance, we may have had that opportunity to help them with repairing their credit,
Right,
or having
right.
them maybe adjust their income, or how they're actually showing their income if they're self-employed. Like managing those expectations and providing this roadmap
Yeah.
to be able to get you more options and choices, so that you're not just stuck with renewing or potentially not renewing. Because what I'm seeing this year, and especially into this last quarter, is some banks, and a lot of them now, can and have the right to check people's credit before they're up for renewal.
Yeah.
There's this there's this, I don't, it's like an underlying understanding in Canada where homeowners feel that they can just be offered a renewal and that their bank will not requalify them or
Right,
check their
right.
credit or ask for income, and that's not true.
Yeah.
Yes, the federal government says at renewal you don't have to qualify with your existing lender. They can offer you, they can. But in the contract that you sign, your bank has the right to check your credit at any time.
Right.
And what's happening is I'm seeing people actually not being offered renewals. And it's because what's happening is these banks are looking at their credit for a homeowner or an individual, and if they're over leveraged with their credit and their credit scores have dropped, and they feel that they're at risk, they may one of two things: offer them a renewal at higher rates and not enough products, so just maybe a 1 year or 2 year term,
Right.
or they may not offer it at all.
Yeah.
Well, I think that right now there's a large age demographic of 55 and up in Canada. In fact, when we look at mortgage products in Canada, there is research and forecasting that banks like EQ Bank, Home Equity Bank, these are lenders that offer what's called a reverse mortgage. Now, there's a very negative connotation on a reverse mortgage, where there's this understanding from years ago that, I think it was more in the States with this type of product, that you would take this mortgage at time of retirement, and basically the bank ends up having your mortgage because it eats away at the equity of your home because you're not making mortgage payments, right? Because you're on a certain pension income, you're set, you're retired. And that's simply not the case, okay? Especially here in Canada. These mortgages are there to help in times of, I call it equity-based mortgage lending, meaning that, as you know, when you're coming up for retirement, there's going to be a set amount that you're going to be receiving every month. Your income realistically is not going to be going up for the remainder of your lifespan. And so we want to make sure that you're adjusted to be able to accommodate that financially and still potentially stay in the house you want, or look at buying a house that accommodates as you get older. A lot of people want to get into a bungalow, a smaller space, square footage, because their children are out of the house. And so that's why I call this right sizing, because it's right sizing to what's accommodating you and your family, or you and your wife or partner at this time, to where you need to be in your lifestyle, your with where you are with your employment or retirement. And there's a large amount of population that need to do right sizing. I also say right sizing is for some people too, that the house is too unaffordable for them at this point. And it's not, it's making sure that you're getting that house that suits your financial position right now at this time.
Right.
But going back to that retirement piece, it's a lot of work to be able to really sit down with people, because people, I find, have not budgeted or looked at their financial well-being over a period of time of what does the next 5 or 10 years look like. And so we really got to break that down for people so that they have a good understanding and a good grasp of what this looks like for them, and get prepared from a mindset of, okay, what they need to do to move the needle on that, right? And you and I talked about that. I mean, Brock, even with your situation too, right? You're going to be close to retirement coming up shortly. You've got, one of your children in the house. I do as well.
Yeah.
What does that look like? Does a house accommodate it? Is it suitable for you and your wife to stay in it, right? And these are conversations, I think, that are going to be becoming more popular, right, going forward.
Absolutely.
And I also think because there's so many mortgages coming up for renewal next year too, there's a lot of people in that age demographic that are coming up saying, you know what, do I really need this house? And is there something that's going to better suit for the next 5-10 years as I come into retirement, maybe in the next 5 years, and what does that look like? So I think that there's going to be a lot more of those bungalow houses being sold. They're always been popular. I think that will increase. We might see more people moving out of the city area that's more expensive, going to different
Right.
areas that's
Right.
more affordable, and maybe their children will follow because they want to have a better quality of life and have their money make money and spread out for the longer period of time so that they're not financially stressed, as they get older.
Absolutely. And I mean, and I'm half joking when I say this, but these are the things that I think about at the age that I'm at when it comes to homes. My knees, going up and down the stairs, yard work. What is it that brings you joy? And I know that a lot of people, when they look at their home, there's obviously tradition that's tied to the home, and people thinking, love having those large family gatherings and everybody around the table. How many of those days actually happen in 365? Maybe 3 or 4,
Well, that's
right?
it, right?
Why don't you all go out for dinner somewhere? And again, I don't mean to tell anybody what to do.
Yeah.
But that's that idea of, like you said, 5 years, 10 years, 20 years down the road. And the other thing that I haven't spent a lot of time learning about, and I don't know what your where you're at when it comes to it, there's a lot of land lease products out there where the home, when you go and you make the purchase, you're purchasing the home, but you're not buying the land. You're leasing the land. That may work for some people, but again, I don't know if it seems to be that's what a lot of retired people will do. They'll make a purchase like that, but the land is always owned by the owner of the property. I'm guessing that there's pros and cons to that. As I said, I really haven't spent a lot of time looking into it, but those are the kinds of things that at this point in our lives, like you said, you start looking 5 years, 10 years down the road.
Well, I think so, and you're right. There is products like that. Financing is a little bit more complex,
Right,
but
right.
here's the thing: a lot of people buying those type of properties have sold a house, have the equity, and are
Right.
able to purchase those type of properties free and clear.
Yeah.
So that is popular. I think that we might see where I'm seeing a lot of things right now on where we're still keeping the existing house, but maybe the kids are at the point where they're working full time. They
Right.
come together,
Yep.
they buy the property from the parents, and then the parents end up moving into the income suite in the basement or like in a different part of the home, or they add an addition onto the house.
Yeah.
So the parents, so the children can still keep the home, and it's still a generational property. We're seeing actually a lot of that, and I think because a lot of the policies and zoning has changed with the municipalities to allow what we call building up,
Right.
not necessarily building out like
Yeah.
builders do
Yeah.
with land, because land is so expensive. And let's face it, I mean, we're having challenges with a lot of builders. We're at a low time, an all-time low of new homes being built just because of affordability right now and the cost of just completing proper projects. And that's a whole different elephant in the room. We can do a whole hour on that, right? So I think that with challenges, there's opportunities in the market. I think, getting back to renewals, we really didn't touch on a lot of where I wanted to go on, where there was, this conversation on renewals about what do people do at this point? Do they sell? Do they stay in their home? Are they able to consolidate their debt? What is the next steps? And I find that this is where, and I say this to people, your financing is not the same as the next person,
Right.
nor is your bank account. You have to sit down with a mortgage professional and really work out what those strategies look like for you based on the guidelines that are out there on the financial programs that are available for you. And the good thing with mortgage professionals is we do have multitude of different lending products. And I'm finding it's getting tougher for them to qualify in that A program of the banks, lenders, financial institutions for best rates, because you're very boxed on amortizations and your gross debt ratios, your total debt ratios. And we have to maybe look at that alternative or private space because of where people are at with their debt to income ratio. And so it's a conversation to have so that people can set the expectations, getting ahead of it, having the call, giving us a call, even if you're a year out from your renewal. It helps get you a better mindset of where things are going and where the shifts you need to make, right, for you and your family.
You must have a lot of your clients have these aha moments. They're like, oh man, you put my mind at ease that we've been able to figure this out, because sometimes what it takes is a fresh set of eyes to look at what's going on, because as a homeowner, all of these other things that are going on, and as we've said before, sometimes it's emotion, sometimes it's all of these other things. You're looking at it, and you're not a disinterested third party, but you're looking at this from the lens of 25 years of experience to say, have you considered doing this, or have you considered doing that? And that might be just enough that these people are like, yeah, we can make this work.
Yeah, and I think it's been, I mean, I've always enjoyed speaking with people. I'd love to hear people's stories. I mean, it helps make this easier for me to be able to have conversation and provide education to the community because you're dealing with real life issues and real life struggles with people. And then to see the wins is rewarding. I think I'm very, very, very privileged to be able to do this and help people with financial solutions. But to your point, it's a couple of conversations. Listen, this is not easy for a lot of people. Even any change is not easy. It's hard enough, and then navigating the complexities of the market and the global world. There's a lot of noise out there. But able to break it down and give people time to think and process is realistically what I'm trying to communicate out to people. It's not to make a choice in the day you come in to see us or have the conversation with me on the phone. It's to provide you education and tools and opportunities of looking at financial strategies that are best suited for you and your family. And like I said, no one's the same, but you have to fit in these boxes in Canada with financing, just like you do in the U.S. But we're limited in how many we have because we don't have the broad spectrum of lenders that are out in the U.S. However, there's still a lot of options out there for you. The good thing in Canada is we have equity. We still have a lot of products out there to help people. You know, home ownership overall, the forecast is still good. We're still looking at stabilization in the housing market, a slow recovery, but it's still a recovery. We're looking at interest rates coming down, and we're looking at whether or not we can agree with government cash injection into the market and into businesses to help them sustain. They're looking at ways to help it sustain and still grow in a challenging market with tariffs. And I think that we have to stop the noise sometimes that we see and just focus and put our oxygen mask on ourselves, right?
I like that.
And really fix what we need to do to move the needle for ourselves. Because if we all do that and speak to professionals out there, we'll be better off. And then the next family will, and the next person will be. And I think that's where I'm really trying to get that messaging out there. Put the oxygen mask on for yourself. You deserve it. You and your family. Sit down with a mortgage professional, the professionals that are in your spectrum of what you've built over the last few years with financing. If you don't have it, we can make recommendations. And really sit and make sure that you're making the changes that suit the needs of what you need to do for you and your family.